Good morning and welcome to our presentation today from Public Safety Personnel Retirement System on Member Benefit Overview. We hope that this overview will help you as local board members have information that you can present to your members as you move forward with them explaining what their benefits will be. We have a few objectives that we'd like to set out for today. The first one is explain the retirement terminology. The second will be discuss retirement criteria and options. The third would be review the pension calculations and provide an overview of the benefits available. So you can see from our objectives today, this is information that you can use as perhaps a local board secretary and present this to your members so they would understand exactly what their benefits will be as they get ready for retirement. So with that said, let's take the first objective and talk a little bit about the retirement terminology. We want to visit a little bit about today, Tier 1 and Tier 2 members. We'd like to visit a little bit about the service and credited service and the compensation, how it's calculated. So let's start with the Tier 1 and Tier 2 members. This is important for you as local boards need to understand and for your members to understand as well which criteria that they fit into. A Tier 1 member is an employee who became a member before January 1st, 2012. This does include those employees who terminate employment after 2012 and transfer their time between PSPRS employers. A Tier 2 member is somebody who became a member on or after January 1st, 2012. So we want to make sure you understand there is a difference between the two different types of tiers or a membership based off their hire date. There is one exception to that, the Tier 1 members who terminate and refund their accounts and then subsequently redeem this time with the same or another employer after January 1st is considered a Tier 2 member. There's a little bit of confusion about that. We want to make sure everyone's clear that if they've taken their money out, refunded it, then they do not have a chance to, they actually are a Tier 2 member. So with that said, let's talk a little bit about service and credited service. As we know in the plan, there's service as somebody works over the various years, and there's credited service. Let's make sure there's a fine line between the two and you understand the difference between them. Service is the total time you've been employed. It includes your leave without pay or any time off that you had. Credited service is a little different. This is time employed in which your contributions were paid, and it does not include leave without pay. In other words, you might have been working, got hurt on the job, took a month off, and you did not make contributions to public safety. Therefore, it would not be counted as credited service. This is used in the pension calculation to determine exactly how much you would get when you get a benefit. Leave without pay only affects the credited service when contributions are not made for that entire pay period. You can retire with the required amount of service, but you have to be reduced benefit if you have less amount in the credited service column. And that would be easily explained if you worked 20 years as an employee, but you took 2 months off for whatever medical reasons it might be and did not make contributions, you'd have less than your normal time of service. Now let's talk a little bit about the compensation for a Tier 1 member. It's actually calculated off the average monthly benefit compensation. You would take the highest 3 years of your salary out of the 20 years of employment, and you have to look at any 36 consecutive months. This normally doesn't include, it includes the third-party work under specific circumstances if you're sent out on a fire detail or something of that sort, but it does not include lump sum payments at retirement for any unused vacation or sick time. Let's take a look at the compensation for a Tier 2 member. Now, this is again somebody who was hired after January 1st, 2012. It's the average monthly benefit compensation based off the highest 5 years of consecutive years out of your salary in the last 20 and it has off the consecutive 6 months, 60-month period of time. So it's a 5-year average versus a 3-year average. It includes third-party work, as we mentioned before, but it does not include the lump sum payments, unused vacation or sick time when you get ready to retire. What we'd like to do is take just a minute and open this up for questions. We have 4 different segments here that we'll be reviewing, and if there's any questions during those segments, we'd encourage you to type those questions in, send them to us, and we'll get those responses to you. If not, we'll go ahead and proceed then. Now what we'd like to do is look at the criteria and calculation for a Tier 1 member for a normal retirement and a deferred annuity. A retirement criteria for a Tier 1 member is pretty straightforward. It's employees who became members before January 1st, 2012 must meet the criteria in order to qualify for a normal pension. A lot of times the question comes up, what is a normal pension? Right now, for a Tier 1 member, it's 20 years of service with no age requirement, or you can have 15 years of service at age 62 years of age. That's the criteria as it's mentioned in the law. Now, to calculate that for a Tier 1 member, you'd look at the 20 years of credited service would equal 50% of the average monthly benefit compensation. Then, if you had more than 20 years, you'd add 2% of the average monthly benefit compensation to the benefit for the years between 20 up to 24.99 years of credited service. If you worked beyond that, at 25 years of service, the multiplier increases to 2.5% for all the years of the years of service. But if you had less than that, you would subtract 4% of the benefit for each year under the 20 years of credited service. And that's why we wanted to define the difference between the credited service and the service, as we talked about a few minutes ago. The maximum pension for a benefit is 80% of the member's average monthly benefit compensation or 32 years of credited service. In other words, if you get to 32 years, you max out and cannot get more than 80% of your high 3 years for a Tier 1 member. Now, there is something called a deferred annuity as a benefit for a Tier 1 member. That's somebody who is maybe inactive members, not currently contributing to the system, but maybe they have 10 years of credited service. They may elect to receive a deferred annuity at age 62. We have very few that fall into that category, but it's still on the law of the books and it's still available. It's a lifetime monthly lifetime monthly payment, actuarially equivalent to the member's accumulated contributions in the system plus the equal amount paid by the employer. The way that works is kind of like it's exactly what it says. It's an annuity. It's not a pension. There's no survivor benefits, no benefit increases, and no health insurance subsidy. That's why this is an old law that we still have on the books, and it's still available to anybody that reaches the age 62 with 10 years. But it's an annuity, not an annual benefit, as we've discussed so far. Any questions about a Tier 1 member and what's available to them? Yes, if they work up to the age 62, they can still apply for that benefit. It's not just for inactive members. This is somebody who's usually left their money on account for all those years. That's a good clarification. So if you're 62 and have 10 years and you're working right up to that 62nd birthday, that's available to you as well. Let's talk about the criteria and calculation for a Tier 2 member for a normal retirement. This question comes up often. What does an employee that becomes a member after January 1st, 2012, and how is that different than a Tier 1 for a public safety normal pension? This individual would need to work 25 years of service and be at the age of 52 and a half before they'd actually be able to collect a pension. How is that calculated? The 25 years of credited service would equal 62.5% of their average monthly benefit compensation. You'd add the 2.5% just like you would up to the 25th year, or subtract 4% for any benefit under the 25 years. The maximum pension for this is again at 80% if you worked for the 32 years. So the major difference is a 20-year pension plan versus a 25-year pension plan. And they do get the actual 62.5% as it's calculated and stated in the law. For deferred annuity, an inactive Tier 2 member are not eligible to receive any deferred annuity. That was completely stricken from the law, and it's not available for a Tier 2 member. Members who do obtain the service requirement, though, for a normal retirement of 25 years, but not at the age requirement, may elect to leave their contributions on account until they reach the age of 52.5. They cannot elect to receive a normal pension because they would not be eligible for it at that point. At that point, they could actually receive a pension. But you could get 25 years of service, sometimes at age 50, but you'd have to wait another 2.5 years before you could actually start collecting the benefit. That's the big difference between the Tier 1 and Tier 2 member. Any questions about that so far? It's only for Tier 1, age 62 and 15. There's no more 62 and 15 for any Tier 2 members. Thank you for that question. Okay, let's talk a little bit about disability calculations now. There's different types of accidental disability and temporary and catastrophic. This is always somewhat confusing to boards, and we need to review this in detail, so we'll take a few minutes on this calculation. If you were to look at a disability type of retirement, you might ask yourself, what is an ordinary disability? What is the difference between an accidental disability? And how is that different than a temporary disability or perhaps a catastrophic disability? These are 4 different types or categories of retirement benefits that an employee who works for a period of time, anytime, could apply for. But as a local board, you would have to make sure they qualified for each of these as they made application for it. And let's go through those for just a minute. So the ordinary disability we'd like to talk about first is not work-related. In other words, it's non-work-related. They may have a physical condition which totally and permanently prevents them from performing a reasonable range of duty. It could be a mental condition which they're not able to continue to work as well. Again, this is non-work-related disability. The benefit is calculated on the average monthly benefit, 50% of the average monthly benefit, multiplied by the credited service divided by 20. So you can see by our little formula that it's a reduced benefit if you calculate that out because it's divided by 20 years of service. The member does not qualify for an ordinary disability if he or she is eligible for a normal retirement because there would be no reduction at the 20 years. So if you look at an ordinary disability, this would be non-work related, and again, it's what we consider a reduced benefit to the employee because it's less than their normal retirement would be. Now, another type of disability might be the accidental disability. This is where it's work-related, and the individual has sustained a physical or mental condition which totally and permanent prevents them from performing a reasonable range of duties in his or her job classification. The benefit is 50% of a normal pension based off of 20 years of service. So it's 0.5 times ABC, the average monthly benefit calculation. This benefit is tax-free if it's under 20 years, which is good for an employee if they need that. And it's also a benefit that's partially taxed for 20 or more years, the way the IRS reads this for this particular calculation. But the calculation is 50% of the average monthly benefit, and the compensation or the amount calculated based on the member's actual years of credited service, whichever is greater. So this is where somebody would get hurt on the job, would make application for a disability retirement, and then they would have to go through the proper procedures of performing and giving the employer, any necessary medical evidence so you could proceed with making this application and fulfilling the requirements for an accidental disability. It would be work-related, sustained on the job. Another type of disability is a temporary disability. This is where it's work-related and they're not able to perform the reasonable range of duties, but there is a caveat to this where the benefit is limited to just 12 months. The benefit is calculated 50% of the monthly compensation at the time of the disability, but after he's gone the 12 months, he or she may not qualify for an accidental disability unless they go through that process. This is where a person may get hurt on the job and hopefully would recover from it or be able to come back to work. This is the only time you'd want to perhaps grant the disability. If they're not able to come back to work, then they'd have to reapply for a different type of disability, whether it's job-related or non-job-related, accidental or ordinary disability. This benefit is limited to those who have not yet reached the normal retirement criteria. So this is something that's still available to our membership, and they're welcome to apply for it, but they better have kind of a plan of coming back to work or making application at the 12 months, because you do have to suspend the benefit at the 12-month period and usually exhaust all the contributions they've made, and they really wouldn't have anything left after this particular retirement. Not highly recommended at this point. Another type of disability is the catastrophic disability. This is where it's work-related, and this is a physical condition only which totally and permanently prevents a person, the member, from engaging in any gainful employment. The calculation is a little bit different. It's for the first 60 months, the benefit is 90% of the average monthly benefit. This is perhaps a very difficult one to grant because this person was injured on the job. It's much more intense than a regular accidental disability. Perhaps they'll never live much past maybe a 60-month period. It's just difficult to grant these disabilities, but they may recover. But after the 61st month, if the member has 25 years or less of credited service, it goes down to 62.5% of the average monthly compensation for a 25-year benefit. If he has less than 25 years, the benefit is based on the actual years of service. Now, we have granted these in the past where perhaps an officer was shot, or a very difficult situation where a car exploded when the officer was in it, or a firefighter goes into a fire. And these are very difficult to determine because usually the individual doesn't maybe last or live past the 60-month period. But it is a benefit to the member and is obviously available to them if a catastrophic type of disability happened to them. Any questions at this point between the 4 types of disabilities we reviewed? Yes, that's a good question. Do they have a survivor benefit with a disability? The answer to that is yes. It's just like a normal pension. The benefit for the survivor would be calculated based off of the actual benefit amount that they were using at the time. And if, it would be like an 80% of whatever their benefit would be, if they meet all the criteria of being married to them and, and involved in their life. So that's a very good question. Thank you. Okay, let's shift gears and talk about some other plan benefits that we have. Members can work and go into what's called the DROP program for the Tier 1 members only. Post-retirement benefit increases. We always get a lot of questions about the COLA increases and what's available, and also the survivor benefits. So let's take a minute now and take a look at some of this other plan benefits that are available. DROP, as we know it, is Deferred Retirement Option Plan. This is only available for a Tier 1 member. It is not available for a Tier 2 member. To do this, the DROP program is a period of time which an individual may have worked, whether it's 20 or 25 years, and they put their money on account. It allows the employee to accrue a lump sum payment while continuing to work during the 60-month period. Now, Now, the way this works for a person entering into drop, the employee receives his or her regular benefit at the time of retirement. It's important that the employee may participate for a maximum of 1 up to 60 months, as low as 1 month. So they can go into it for 1 month up to 60 months and receive a lump sum payment at the end of their drop period. But an individual who goes into this program needs to understand that there's no additional service earned during this drop period. Your pension's pretty much frozen at the time you've retired and you start the drop program. So there's no more accumulated credited service and there's no recalculation of the benefit. It's the exact amount that you have when you leave at 20 or 25 or 32 years, whatever the time frame may be. You can still apply for disability retirement while you're in the drop program. That is still available. Now, a lot of people might ask, what is the difference with the different rates of return that a person in the drop program may have for a Tier 1 or Tier 2 member? If you've reached the 20 years of credited service before 12/31/2011, then you stop paying pension contributions as of the drop date. To clarify this, the drop account earns the interest at the assumed earning rate, and this rate for fiscal year 2013, ending 6/30/2013, is 7.85%. Now, this is a pretty good deal for those who are going into the drop program if they're in it already. If you've reached your 20 years of service after 1/1/2012, then it's calculated differently. The employee continues paying contributions during the drop program, but the contributions will be refunded at the time of termination of the drop program. So this is one of the laws that were passed and changed for anyone that reaches the 20 years of service after 1/1/2012. The drop account will then earn interest at the average annual rate of return. The rate of the fiscal year 2013 has been set at 4.4%. The maximum of the assumed earnings rate of the plan and a minimum of the 2%. So in other words, it's not as high as the 7.85%, but it's only at the 4.4% at this point. But the member does continue to pay in contributions if they qualify for this portion of the drop program, and those contributions will be refunded to them at the time of termination. Does that explain the difference between if you've reached your 20 years versus those that have not reached the 20 years? If a person gets ready to retire and they may be looking for some type of COLA increase, we'd like to explain how that program is being implemented now. For a Tier 1 member, a member who may reach the age of 55 or older on July 1st and be receiving benefits to qualify, or a member who's under the age of 55 on July 1st must be receiving a benefit for the 2 preceding years to qualify. This is for a Tier 1 member to receive a COLA increase or a post-retirement benefit increase. For a Tier 2 member, it's a member who's reached age 55 or older but receiving a benefit, and a member under age 55 must be receiving an accidental or catastrophic disability or KIA survivor benefit for the 2 preceding years to qualify. So just a little bit different in the language for those who qualify for benefit increases for a Tier 1 and Tier 2 member. Now, a lot of questions have been asked recently. How is this actually calculated? Let's take a minute now and review that. Now that we know who qualifies for it, how is it calculated? For the calculation purposes, the fund, in other words, our office, our investment team, needs to earn more than 10.5% in the prior fiscal year for an increase to be issued. The amount of the increase depends on the funding level or the status of the fund itself. Now, to qualify for an increase for this money to be set aside, the post-retirement benefit increase, the funding ratio needs to be between 60 and 64%, and then we'd be able to give a post-retirement increase of 2% on the average monthly normal benefit for that prior fiscal year. If we're funded at a 65 to 69% level, it increases to 2.5%, or 70 to 74%, 3% increase. If it's 75 to 79%, it's 3.5%, and 80% or more, then it's 4%. Now, if the earnings are in excess of 10.5% are insufficient to grant the maximum benefit allowed, as it's set forth above, then the percentage increase will be limited to the percentage that can only be funded by the earnings that are available. So right now, we're around 56% funded, and if an investment team had 10.5% return, would we pay out an increase? The answer to that would be no, because we're below the 60% funding level. We need to get our funding level above 60% in order for us to pay out an increase for COLA increases. Now, we don't have any COLA, we don't have any post-retirement benefit increase money set aside, so there will be no more COLA granted going forward unless we meet this criteria. So you might get a lot of questions from your members. When will I get a COLA again? This is the best way to explain it to them between this particular slide right here on the calculation of 10.5% return. If the funding status is available, then we have to be above 60% to be able to get the COLA increase. And right now, I don't see that happening this year or next year based off the way the trends are going. Now, does that answer your questions about the COLA increases? We'll take questions in just a minute. Let's talk about the survivor benefit for the spouse. A spouse of a retired member must be married at least 2 consecutive years in order to qualify. The spouse of an active member must be married at the time in order to qualify. In other words, you need to be married for 2 years if you're receiving a benefit, if you're in the retirement mode right now. But if they're active, they could just need to be married at the time to qualify for the benefit. The spousal benefit is 80% of the monthly the member's pension. And the benefit for a spouse or a member killed in the line of duty is 100% of the member's average monthly benefit compensation. Now, these are great benefits you can explain to the members. This also applies to those that are in the disability or any other programs that they have retirement benefits coming, except the deferred annuity. Now, how is that calculated for children? A survivor benefit. Child's benefit may be payable to the dependent children or child at the age of 18 if they're under 23 and they're a full-time student, or they may be permanently disabled before age 23. That's the reason for that is the child may also be able to get some money to help them through their educational process if they're a full-time student between 18 and 23. There's a limit of 2 child shares receiving a total of 20% total, or 10% each if there's 2 children involved. So this is, again, another addition to the survivor benefit if there's eligible children who qualify. So let's entertain questions about some of the other benefits we've just reviewed. Any questions from those that are here today about COLA increases, about survivor benefits, things we've reviewed recently? The answer is no. They're always the same for that spouse because she's entitled to them. Good question. So if the spouse always gets that benefit because she's entitled to it because she was married to the retiree for all those other years. Okay, we want to make sure everyone understands that there's also other benefits in the insurance arena. And as you take this PowerPoint presentation, you may share it with your members. You might explain to them also that there's healthcare insurance subsidies available for a person who takes out public safety, the insurance available. Public safety provides a monthly subsidy to offset the insurance premium costs for the retiree. The coverage is only for the retiree and the eligible dependents or the survivors receiving the retiree benefit. The subsidy amount is based on the insurance coverage, whether the person is single or family, and Medicare eligible of the plan members. So you can't just you just don't automatically get a subsidy. It has to be under one of these criteria we're talking about here. The subsidy is applied to the total amount of the cost due for the medical or dental insurance. Any remaining premium is deducted from the retiree's benefit. In other words, you may have a premium of $1,000, and there may be a subsidy of X amount of dollars applied towards that premium to reduce the cost to you. Now, the health insurance subsidy, the member must be enrolled in either an employer plan, and the subsidy would apply only if the employer plan if the member is using at the time the retiree is not an active employee, or a system plan like ADOA or ASRS, whatever you may qualify for. Now, a lot of people say if I do take ASRS insurance or an ADOA insurance package or whatever it might be, what amount do I get as far as the subsidy? You'd get $150 if you're a member only, or you get $260 if you have a member and a dependent on a family coverage. And that's what most qualify for if you're not Medicare. It's a single coverage, or $260 for family coverage. But if it's a member only and you have Medicare eligible, then your single coverage is $100. If it's a member dependent and a member dependent is on Medicare, for family coverage it reduces to $215. And it reduces to $170 on a family coverage if the member and dependent, one or more dependents, are Medicare eligible. So you can see that there is a subsidy available, and it does help with the premium costs that the employees may have. Now, the other insurance subsidy that's available would be the cancer insurance program. Now, this is available to the member while they're working and even after they retire. This is a best kept secret that we have here at Public Safety, and we want to make sure everyone's aware of what this plan entails. The Cancer Insurance Program, CIP, was created to assist the members and retirees with expenses incurred in the treatment of cancer. The employers pay an annual premium for every eligible active member, and there's no cost for the active members to participate. In other words, all the employees that you have right now, you are paying for them to be part of this plan. Upon retirement, the member receives 5 months of paid coverage for every 1 year of credited service. Retirees may assume the employer cost to continue after. Right now it's $50 a year if they chose to do so. And the active and retired PSPR members who, prior to their membership date, have not been medically treated for diagnosis, maybe having cancer treatment, may enter this program if they are eligible. So what we're trying to say is this cancer insurance program is a self-funded program that we do administer here in the office. The program pays for perhaps the first occurrence of a benefit of $8,000 once the diagnosis of cancer is made. Reimbursements are subsequent to the member's expenses. There's a lifetime benefit of $100,000. All claims must be made within a 24-month of the occurrence when it actually happens. The Board of Trustees changed and updating these provisions for the cancer insurance program ever since its inception. The complete details are always located on the PSPRS website. But if you do have skin cancer expenses, they are excluded from the first-time occurrence for this benefit. So we wanted to make sure you're aware that the cancer insurance program is now being funded and paid for by the employers. All active members are involved, and each of the employees should take advantage of it if they actually have or contract any type of cancer. Now, if an employee needs to make application for one of these benefits we're referring to, they can contact our office and make those claims. And we'll give you the name and contact of those individuals in a few minutes. Additional benefits that are available for service purchases, service transfers, or purchase of a firearm. Now, we want to take a minute and go over some of these benefit options. For a service purchase, an active member can purchase prior to service, added to his credited service to the public safety pension plan. Purchasing prior service helps the retiree sooner retire with a larger benefit due to the additional accredited services being added. Members who have 5 years of accredited service with PSPRS to purchase qualified public service and 10 years of accredited service with PSPRS to purchase the prior active military time. So there are some qualifications to be able to purchase your time. The purchase is limited to a 60 months of prior public service or 60 months of prior active military service. But this is a great benefit if somebody has other service that they want to purchase in and add to their accredited service. These service purchases, a commonly typical one might be prior active military service. Maybe they've reached that at 10 years and they'd like to purchase up to 60 months because they were called up and they were working in another capacity in the military. There are prior or out-of-state service or rural metro service. If you had 5 years of service with us, you could purchase up to 60 months. Does that make sense how the chart reads? Prior forfeited service, there's no time, all previous forfeited service. Other Arizona state retirement plans, it's not, you don't have any time, but all service could maybe be purchased at a price. So these are all purchasing types of service for prior working experience that you'd want to add to your accredited service within the plan. To view or estimate these costs of these purchases, you can log on to Members Only account on our website and use the online estimator. If you actually want to kind of get an estimate of where the member wants to do it. As a local board, you don't need to actually go through this process with them. But to purchase the prior service, you can contact our Public Safety Retirement Active Member Services Department, and they can give you exact figures to begin the paperwork process. And this is a great way for a person to add to his service if he's purchasing prior time that he had. And we'll give you contact information for that in just a minute. The next thing we want to go over is if you're not purchasing your service, perhaps you want to transfer the service from another employer. Active members can transfer certain prior service in Arizona to add to their accredited service to public safety benefits. And again, you don't need to calculate this. It's all done in our office here. Completing the service transfer may help you retire sooner with a larger benefit as well. And this is how this works on a service transfer. The contributions from a service with another PSPRS employer can bring it in. In other words, if they're in PSPRS, they can transfer that time over directly to us. If the credit service from a selected Arizona retirement plan, like ASRS, Corp, elected, or public safety, that's where you could transfer the time in. Service for another retirement plan, retirement system, or a municipality of the state of Arizona. So there are different ways. If you had prior service with ASRS, for example, you could bring that service over to public safety and combine it to add to your accredited service. So let's take a minute. This is something that a lot of employees aren't aware of also, but you can actually purchase a firearm. This is another benefit that's in the law. Upon retirement and subject to approval by your employer, public safety retirees can purchase handguns or shotguns issued to employers to the employee at the less or fair market value. And then you as an employer would make that determination what that cost may be. Now I'd like to entertain any questions we have about the service purchases or the things we've talked about recently on transfers. Just to kind of review and recap, hopefully this explanation has been helpful for you because a lot of employees who we've talked to in the past weren't even aware they could buy their military time, for example. Okay, we have a few questions now. We're going to cover that actually in our next part of the presentation. I'm glad you brought that question up. You can buy prior military service, and in most situations you can purchase prior fire service, but there are some qualifications to each of those. So you'd want to contact LaDawn Toger in our Member Services Department to see which one would qualify. That is correct. I'm going to defer that question to LaDawn as well. That's a good question. I don't remember off the top of my head if the second part of that question. So we'll ask you to call LaDawn Toger in our office, and she'll be able to answer that question for the rural metro time. Let's talk about a little more additional information that you need to know about that's come up recently, and that would be employee contribution rates, return to work after retirement, and available resources that we'd like to discuss now. Employee contribution rates has been a big topic this last few years because they've definitely risen over a period of time. In 2012-2013, an employee would be paying in 9.55%. For fiscal year next year, it'll be 10.35%. The fiscal year after, it'll be 11.05%. And going forward, get up as high as 11.65%, or 33% of the member's contribution rate. And we'll worry about that when 2015 comes around. But we just want to make sure the employees are aware for this great plan that they're in, the employee contribution rates are on the rise. And these are all set forth with the law. They used to be 7.65%, and now they're rising to 9.5%, and the employees need to be aware that they'll be up to 10.35% next year. Let's address the issue that we brought up earlier about the return to work rules. Retirees who return to work are subject to the following situations. Perhaps they're not eligible for a pension payment if they return to work with the same employer in any paid capacity within 1 year of retirement. This is the way the law reads now today. There are a few exceptions to that rule, and that would be an exception would be a retired member who are hired as a fire inspector, arson investigator, or an entry-level position, non-supervisory employee must remain for a minimum of 60 days and must have been hired through an open competitive process. So that's the one exception if they're going to sit out 1 year. If a retiree does become reemployed by the same employer in the same position, will not receive his pension payments. That's the way the law reads today. So in other words, if you have somebody who's coming back to work, they do have to sit out a year or come back with another employer in a different capacity, essentially what the law says. You can't have the same guy come back to the same position anymore in public safety. A few other return to work rules. Retirees do not make contributions unless they were on a disability pension, and they do not accrue credited service if they do come back to work. Retirees who return to work are not eligible for health insurance subsidy if they receive their health insurance coverage as an active employee. Also, employers must make an alternate contribution to PSPRS based off the retired member's new salary if the members are returning to the position in the same plan. So this kind of outlines and explains the question earlier that return to work rules do apply to most anybody, especially if they want to come back to the same employer. They do need to wait 1 year. Now, what I'd like to do is give you a few points of contact. My name is Don Minear, as we mentioned earlier, and we've also got Robert Ortega in our training department. And you might want to jot down LaDawn Toger, who is from the Active Members Department, who can help you with the service transfers, service purchases, or any credited service an individual may have where the contributions are being made. The Retired Members Benefit Manager is Lonnie Brown, and she can be reached through this email. If you have any questions about the insurance coverage that we offer, Annette Jorgensen is a great insurance point of contact, especially for the cancer insurance, because all that information is funneled through her and her department, and it does not have to go through the employer. They don't need to know about anything about the cancer insurance cancer that maybe somebody has contacted in the past. Again, you can contact me at any time if you have any further questions, or Robert, or LaDon, or Bonnie, or Annette. As we'd mentioned, we have plenty of resources in the office here to get your questions answered. We hopefully you'll schedule time with your employees and present this material to them as a local board secretary or as a board member, because this is valuable information that all employees need to be aware of what their retirement benefits are. And this has been a great review process for you to understand what they are, and also transfer this information to those who are working in the field. Thank you for attending.